So the first thing we need to know is that there are two primary types of insurance. There's property and casualty and life and health. Property and casualty consists of homeowners, auto insurance, and business insurance. Life and health will comprise of life insurance, health insurance, disability insurance, and other types of health, life-related aspects. For both aspects of insurance, you will be required to know these primary people. The first person that we're going to learn is called the insurer. The insurer means insurance company. That's like Blue Cross Blue Shield, State Farm, Allstate, Safeco. Pretty much any insurance company is going to be called an insurer. Sometimes we call them insurance carriers, but we're just going to refer to them as insurer. The next person in line is called the insured. In the real world, you're going to call that the insured. I say insured sometimes, that way you know what I'm saying, just because I speak so quickly sometimes. The insured, also known as the insured, is the person who has insurance. Now, just because the insured is the person that has insurance doesn't mean that they are the person that bought the insurance. The person that actually pays the bill is known as the policy owner. The policy owner is the one who owns the policy, and they're the one that can do whatever they want. So to give an example, a policy owner could be me, and the insured could be my wife, Michelle. I pay the premiums, but she would be the one that actually has insurance. That's called third-party ownership, because the policy owner and the insured are two different people. We'll talk more about third-party ownership when we get into the group chapter, but the policy owner is the one that owns the policy. The policy owner can do whatever they want. The policy owner is the one that purchased the policy. The policy owner is the only one that can make changes to the policy. The insured is the person that has insurance. Think of it this way. If you buy insurance on your child, you're the one that can choose the coverages, you're the one that can cancel the policy, you're the one that has to pay the premiums, but your child is the one who's actually covered by that policy. The next person in line is called the producer. The producer means insurance agent. Anytime we say insurance producer, we mean insurance agent. Anytime I say agent, I mean producer. You're not actually applying to get an insurance agent's license because that does not exist. The only license that you can obtain is called an insurance producer's license. So the insurance producer is the agent is the producer. What will happen is you will become a producer when you receive your license, then you'll become an agent of the insurance company. And that means you'll represent the insurance company. The producer's primary job is to sell insurance, solicit insurance. We also market insurance. What we do is we find prospective customers, then we schedule appointments, then we sit down with them, and our job is to ask them questions. They relay the information to us. We write down their answers. Then at the end, the producer signs the application because we represent the insurance company. The policy owner signs the application because they have to agree to pay the bill, and the insured also has to sign the application because in order to have insurance on somebody, they also have to know and they have to agree to it. So the producer, policy owner, and insured all sign the application. Now, a little bit later on, we're going to learn somebody called the underwriter. The underwriter is somebody who works for the insurer. They're going to be the person that does all the hard work for us. As a producer, we just sell insurance. The underwriter is going to be the one that sets the price, issues the policy, and is the one that can decline people, accept people. As a producer, we're just the salesperson. Insurance is the transfer of risk from one individual to an insurer. The insurer then spreads that risk across a group of people. The policy owner is the one who pays their premiums. The insurer promises to pay claims if a claim occurs. Risk is the uncertainty of loss. So every day in your life you take a risk. Doesn't matter what you do. When you drive to work, you could get into a car accident. Every day you have an uncertainty of loss. To protect yourself from that loss, we buy insurance. Now, insurance does not eliminate risk. Just because you have insurance doesn't mean that you're not going to get into a car accident. But what insurance does is it transfers that risk from you to the insurance company. So if you get in a car accident, instead of you having to pay the claim, The insurance company will pay the claim for you. So insurance is the transfer of risk. Risk is the uncertainty of loss. There are two definitions of risk. There are pure risks and speculative risks. A pure risk is the type of risk you take where you have no chance for financial gain. We'll come back to that in a second. The speculative risk is the type of risk you take where you are trying to make money, but you also have a chance to lose money. A speculative risk is where you have a chance of earning income, but also losing income. Insurance will only cover pure risks. We cannot insure speculative risks. To put this into perspective, if your house burns down, you don't make any money. Therefore, that's a pure risk. Even if the insurance company pays you for your house burning down, all they've done is make you financially whole. You weren't actually trying to make money when your house burned down. You just wanted to be made sure that you were financially whole after that claim. Speculative risks are more along the lines of gambling. When you go gambling, you're trying to win money, but you also have a chance to lose money. If you call an insurance company up and say, hey, will you cover my gambling losses this weekend? They will not say yes. They will say no. Same thing as stock market losses. If you're investing in the stock market, you're trying to make money, but you also have the chance to lose money. We can insure real estate, such as a home, under pure risks, but the fluctuations of the value of that real estate we cannot insure. If a person purchased a home for $300,000 and today it's only worth $200,000, you can't call up your insurance company and say, hey, my home is devalued, please pay me money. Won't work. So insurance will only cover pure risks. We cannot insure speculative risks. Pure risks are the type of risk where you have no chance for financial gain, such as a broken leg, such as a house burning down, such as a car accident. Speculative risks are the type of risks where you have a chance to make money, but you also have a chance to lose money. We cannot insure speculative risks such as gambling, investing in the stock market, or the fluctuation in real estate. Next words we have up are called hazards. A hazard is the increased chance of loss. There are three types of hazards: physical, moral, and morale. A physical hazard is the type of hazard that increases your chance of loss, but you can touch, move, pick up, feel, change that hazard. So to give you an example, a pothole in the road, that is a physical hazard. That's physical in nature. Hopefully, if you see that pothole, you can just swerve around and not hit it. But it does increase your chance of loss by having that pothole right there. So hazards are the increased chance of loss, and the first type of hazard is called a physical hazard. Hazards do not always lead to losses, but they do increase that chance of loss. A moral hazard is the type of hazard that increases your chance of loss, but it's more along the lines of a habit. It's something that a person does over and over again. So smoking would be a moral hazard. Lying on an insurance application would be a moral hazard. Hazards are when the insured is dishonest or has little regard to their future responsibilities. Fraudulent claims, lying, smoking, drug addiction. You can't really touch those things. You can't pick them up. You can't change that. Well, you can change them, but you can't just pick them up and move them. A morale hazard is the type of hazard where you are indifferent to loss, or careless to loss, or imprudent to loss. A morale hazard ends in an E. Indifference also ends in an E. Carelessness has a lot of E's in them as well. Morale hazards are kind of like road rage. They're temporary lapses in judgment. You might have done something that you wish you didn't do, but you've likely learned from that mistake. Morale hazards would be an example of you're just driving down the street, somebody pulls right in front of you, and you're angry, so you tailgate them. A few minutes later, it all disappears. A morale hazard would also be an example of, say, somebody putting on makeup while they're driving. It's a lapse in judgment. A morale hazard would be such as running to catch up to somebody when you know you shouldn't be running. Say you're in an office building, which would not be a good idea to run in an office building. So physical hazards are items you can pick up, change, move, feel. That would be an example of a broken step, trash debris on the floor, or medical conditions that a person has. Moral hazards are habits that a person has where they're either dishonest, smoking, drug addiction, lying. Morale hazards are, on your state exam, going to refer to carelessness, indifference to loss, also known as imprudence to loss. The way I remember these three are morale hazards, have an E on the end. Imprudence, indifference, and carelessness all have a lot of E's in them. Moral ends in an L. Lying ends in an L. So I think of moral, lying. And then physical is kind of simple. So hazards increase your chance of loss. They do not always cause loss. A peril is the thing that actually causes the loss. Perils are very important in the insurance world. Perils are what the policies actually insure against. So such as car insurance. If you get into an auto accident, that is a peril. The accident caused you to lose money, so therefore the policy pays out. A peril for homeowners insurance would be considered fire. If a fire causes you to lose money, makes your house burn down, the policy will pay out for that peril. What do you think the peril is for life insurance? Death. If a person dies, the life insurance will pay out. Health insurance, you have accidents and sickness. If a person gets into an accident or has a sickness, has to go to the ER, doctor's visits, everything like that, those are all considered perils. Disability insurance protects against loss of income. So a peril is the cause of loss. That's the reason why a person actually lost income. A hazard was the increased chance of loss. On your state exam, perils are found in the insuring clause of a policy, also known as the insuring agreement. Perils state exactly what the policy is insuring, so you will find the cause of loss listed in the insuring clause and insuring agreement. Loss just means that you had to lose something. An insurance policy will not pay out unless you have had a financial loss of some kind. So to give an example, if you have a fire in your fireplace and nothing happens, your policy would not pay out. You couldn't call up your insurance agent and say, hey, I have a fire in my fireplace, can I receive some income? They'll say, well, did it get out? Did it burn down your house? No, it's just in my fireplace. In order for a policy to pay out, it has to have a loss. That loss must have been caused by a peril, and typically hazards preceded that peril. Next word we have is called exposure. Exposure is a unit of measurement, such as feet, inches, gallons, fluid ounces. Except exposure is what we use in the insurance world to measure a person's chance of loss. It's how prone a person is to loss. So, women live longer than men. That's for a multitude of reasons, but a 30-year-old woman is expected to live to 83 right now. A 30-year-old male is expected to live to 81. So women are less exposed to death than men. So women would receive lower life insurance rates. Now, women also go to the doctor more. So prior to the Affordable Care Act, women used to pay higher health insurance rates than men, because women were more exposed to having medical losses. Now we have the old adage, who's a better driver, men or women? And the question is, who gets better insurance rates, men or women? And women receive better insurance rates. So if you use statistics to figure out who is more prone to loss, men are higher risk than women, so therefore women would actually be a better driver than a man. And again, that's just statistics. You can have your own life experience with that. But exposure is a unit of measurement. We typically use sex as one, male and female. Age is another. We'll also use occupation. We can also use avocation. Avocation means your hobbies. So like race car drivers, skydivers, firefighters. Well, firefighting is an occupation. But any of your hobbies will increase your chance of loss, and that's known as avocation. Now, since we all have risk, there are different ways to handle that risk. This is known as risk management. The first method of risk management is avoidance. Since we can't eliminate risk, we might as well just try to get rid of it and just don't go near it. Avoidance is the act of refraining from an activity entirely. So if you don't want to get into a plane accident, never go on an airliner. You have just avoided the chance of getting into a plane accident. Now, a plane could still hit you while you're walking. I know that. That's why we can never eliminate the risk, but we can try to avoid it completely and entirely. Now, I'm originally from the Maryland area. I currently live in Texas. If I had to drive back to Maryland every time just because I was afraid of flying, that would not be very practical. So avoidance might be the best management option, but it's not always the most practical option. It's very difficult to avoid risk entirely. Risk retention is another great way. On your state exam, retention is also known as a deductible. It's where the insured retains risk themselves. So you can think of it this way. If you have a $2,000 auto insurance deductible, you're probably going to drive safer than somebody who has a $50 auto insurance deductible. The more risk that the person retains themselves, the safer they are going to act. That's why having a higher deductible lowers insurance rates, whereas having a lower deductible increases insurance rates, because the people with the lower deductible are likely going to use the policy a little bit more often than that higher deductible person. Risk sharing is the way of diversification. If you've ever invested money or talked to a financial advisor, they'll almost always recommend you diversify. Because if you put all of your eggs in one basket and that basket breaks, you just broke all of your eggs. But if you have it spread amongst, say, 5 or 10 different baskets, if one basket breaks, you'll still have 20 or 80 or 90% of your eggs left. So sharing is when you split up a risk. You insure it through either multiple insurance companies, or it's also when insurance companies reinsure themselves, just to protect themselves from failing. Risk reduction is rather simple. Risk reduction lowers your chance of risk. If you don't want to have a heart attack, you can run, eat healthy. You can reduce your chance of having a heart attack. If you don't want your car to be damaged by hail, you could park it in a garage or under covered parking. Risk reduction is just the act of lowering your chance of loss. And then the most inefficient form of risk management is actually insurance. Because with insurance, the customer has to pay somebody else to hold money for them. Risk transfer is insurance, but it's very inefficient. It'd be nice if we could buy insurance against anything, but it's not ideal because you'll run out of money. There's an old adage saying that you can never buy as much insurance as you need, because the more money you make, the more insurance you need, and it's just a never-ending cycle. But insurance is the transfer of risk from one person to an insurance company, who then spreads that amongst a group. Insurance is needed though, because if you think of it this way, your vehicle might be worth $30,000 or $40,000. It would be inefficient for you to keep that $30,000 or $40,000 in the bank, just in case you got in a car accident. So we do need insurance, and insurance is the transfer of risk. These are elements of an insurable risk, and remember the two types of risk we learned, pure risk and speculative risk. These are actually the definitions of what a pure risk is. In order to have a pure risk, the loss that occurs must have a definite time and place and must be measurable, meaning you cannot insure something for priceless. Because if you insure something for priceless and it breaks, well, you just bankrupted the insurance company. So insurance companies will not take that on. Insurance companies will not insure catastrophic losses. That's why most insurance policies will exclude war, nuclear war, floods, hurricanes, things that could bankrupt an insurance company they do not like to cover. So insurance companies will not insure things that are catastrophic. Insurance must not be mandatory. Insurance cannot be mandatory. So you might be thinking, well, hey, I'm required to have auto insurance. My question to you would be, do you have to have a car? No. I mean, you can't do anything without a car, but you don't have to have a car. And if you don't have a car, do you have to have insurance? Well, not car insurance. So even that car insurance is not mandatory. We'll also learn a little bit later on about the Affordable Care Act. The Affordable Care Act is also not mandatory because there are ways to get around it. In order for it to be a pure risk, the loss must be due to chance, meaning that insurance companies will not insure intentional losses. If a person sets their own car on fire on purpose, that's not going to be paid out. If you break your own leg on purpose, that's not going to be paid out. And the loss must be predictable to the insurance company. So you might have heard of acts of God. Those have not held up very much in court, but they originally were set into a policy because insurance companies needed something in case an unexplained event occurred. And if an unexplained event occurs and it damages, say, 1,000 people all at once, that could bankrupt them. So insurance companies must be able to predict the losses. They will not insure things that are not statistically predictable. Insurance companies use something called the law of large numbers, which we'll talk about in a little bit. That predicts future losses using something called actuarial justification. So we learned the people a little bit earlier. We learned the insured, the policy owner, the insurer, the producer, and we also mentioned somebody called the underwriter. But we never mentioned somebody called an actuary. An actuary is a mathematician. They work for the insurer, and they set the rates for the insurer for the entire year. Then the underwriter places people into risk categories that the actuary set up, and then the producer sells the policy. So insurance companies have to use mathematicians to determine their rates, called an actuary. And those mathematicians use something called actuarial justification just to make sure that they can predict that loss. So all losses must be predictable. Your state exam could ask you a question. They could say, all of the following are elements of an insurable risk except. The loss must be due to chance. Yes, that's true. The loss must be definite and measurable. Yes, you can't insure something for priceless or forever. The loss must be predictable. Yes. Insurance can be mandatory, and that's not true. Insurance must not be mandatory. So if you do see a question about this on your test, it's more than likely going to be all of the following are elements of an insurable risk except, and more than likely insurance cannot be mandatory. You know that insurance cannot be mandatory, so if your test states that it is, just go with it's not. But these are the definitions of a pure risk. The next definition that we have is called adverse selection. Adverse selection is when high-risk people seek insurance. So if you had an 18-year-old and an 80-year-old, which one would likely go out and buy insurance first? And that would be the 80-year-old. The 80-year-old is higher risk than that 18-year-old, and the 80-year-old will select insurance more than that 18-year-old. So adverse selection is when higher risk people seek out insurance. The insurance companies will insure higher risk people, but they must identify them. That's where the underwriter comes involved. We'll talk more about the underwriter a little bit later, but we've got a little synopsis here. The underwriter is an employee of the insurance company who checks our applications, sets the premium prices, and then finally issues the policy. Underwriters are the party who protect the insurance company from adverse selection, because the underwriter is going to check that application to see if the person's lying. Now, if the underwriter finds out that that person is a high risk, what would they do? Now, if they were just kind of a small high risk, they might just increase the premiums. They can do that in homeowners, auto insurance, life insurance. We'll talk about the Affordable Care Act a little bit later, so try and think of this outside of the health insurance realm. So the underwriter could increase premiums, and if your rates go up, that's going to help offset the risk. The underwriters sometimes impose probationary periods, such as 30, 60, 90-day waiting periods, meaning that your insurance policy won't start up front, you have to wait a little bit. Or sometimes they can have limitations on coverage. So for, say, health insurance or disability insurance, they could add an impairment rider, which would exclude a specific body part. And if that body part occurred due to a loss occurred due to that body part, the insurance company would not pay out a claim. That would be considered like pre-existing conditions, which we don't talk about anymore because they disappeared after the Affordable Care Act for health insurance. They still are well and live with life insurance. If the underwriter finds out that that person is a high-risk person, they could also decline the coverage completely. Now again, don't think of health insurance, but in life insurance, you can decline a person if they are high risk. In auto insurance, if they had 5 accidents, 2 speeding tickets, and a DWI, they could decline that person and not give them coverage. So the underwriter's primary job is to protect the insurance company from adverse selection. Adverse selection is high-risk people seeking insurance. If the underwriter finds out that there is a high-risk person seeking insurance, they would either increase premiums, have probationary periods or limit coverage, or they could decline that risk altogether. Now think back to you as the producer. Our job was to find customers. Our job was to ask them questions, complete the application. Then we sign that application with the insured and send that up to the underwriter. The underwriter does their job, sends it back to us, the producer, then we deliver that policy. Is the producer a person who also protects the insurance company from adverse selection? And some people would say no. They'd say, no, our job's just to sell the policy. But that's not true. As a producer, you will become appointed by an insurance company. An appointment means that you represent that company. And since you represent that company, we do have a role of protection against adverse selection. So let's say that you were trying to sell me insurance. And we're sitting down, and you're asking me the application questions. And I say I'm healthy, 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 healthy. Then we finish up, and I have a 2-pound tumor right on my neck. It's like the size of, say, a mini football. You can't miss it. You see that tumor right on my neck. Is it your job to ask me about that tumor, even if I said I was healthy, healthy, healthy? And it is. The producer does still have to protect the insurance company from adverse selection, because we're going to be the eyes and ears of the insurance company on the front line. A producer is also known as the field underwriter, because if we see something that's not right, we have to point it out. And the way that I remember that is my dad always told me growing up, if the company doesn't make money, I don't make money. So we have to make sure that our insurance company still makes a profit. And if we insure too many high-risk people, our insurance company will not make a profit, so therefore either rates have to go up or the insurance company has to start declining people. So adverse selection is high-risk people who seek insurance. The underwriter's primary job is to protect against adverse selection, but don't forget the producer also protects against adverse selection. The underwriter typically increases premiums, imposes probationary periods or limitations, and they can also decline that customer. Now, as the producer, we just tell the underwriter if we see something, and they put all of this into action. So here's an example of a state exam question. All of the following protect against adverse selection except increasing premiums. Yeah, you increase premiums, either people will go elsewhere, the high-risk people will go elsewhere, or you'll take in enough money to offset it. Having impairment riders. Yes, an impairment rider is where you excluded that specific body part. That was a limitation on coverage. That definitely protects against high-risk people. Declination. Well, yeah, if you decline people, they're not going to have insurance, so the insurance company doesn't have to pay out claims. How about lowering premiums? Would lowering premiums protect against adverse selection? And I say no, because if you lower premiums on sick people, you're just going to get a whole bunch of sick people. So lowering premiums would not protect against adverse selection. Adverse selection is also another reason why the insurance companies have medical exams. Now again, ignore the Affordable Care Act for now, we'll talk about that later, but for life insurance there are still medical exams. Adverse selection is also why the insurance companies pull auto insurance records, or they'll sometimes do physical inspections of a property. They're trying to find out who's healthy, who's sick, who's a good risk, who's a bad risk. If a person's a higher risk, they'll impose some of this, but if they're a lower risk, this stuff doesn't really matter. We'll talk more about adverse selection a little bit later, but adverse selection is high-risk people seeking insurance. The law of large numbers is where the insurance company predicts future claims by using statistics. The person at the insurance company that uses those statistics is known as an actuary. We mentioned them a little bit earlier. The law of large numbers takes a lot of statistics and analyzes them to predict trends, such as younger men have higher accident rates and also have higher rates of getting a speeding ticket. So therefore, if you take a lot of young men and set them next to a lot of young women, the young men will have higher claims than the women because of the law of large numbers. Now, you might have been a great driver, but I wasn't. When I was young, I got in multiple accidents, and I'm a very bad driver. If you're a good driver, you offset me. I'm the higher risk, you're the lower risk. I'm the reason why you have to pay more for auto insurance, because I was a bad driver. The insurance companies also use something called a mortality table. A mortality table is typically used in life insurance to predict life expectancy. If you go online and you can Google a mortality table, you can find out how long you're expected to live. I mentioned a little bit earlier that a 30-year-old female is expected to live to 83. That doesn't mean every 30-year-old female will make it to 83. But if you take millions of women who are 30 and you track them over time, the average age of death would be 30 using the mortality table. So law of large numbers is just using statistics to predict future claims. Next definition we have is called reinsurance. Reinsurance is fairly simple. It's insurance for insurance companies. It protects an insurance company from catastrophic losses using something called a reinsurance treaty. Now we're going to talk about the different types of insurance companies. The three primary ones we want to focus on are stock, mutual, and fraternal insurance companies. You may see questions on the other ones, especially if you're in property and casualty, which is surplus lines. But more than likely, your questions will come from stock, mutual, and fraternal insurance companies. These are the different organizational structures of an insurance company. So we have this word mutual. You might have heard that before, such as Mutual of Omaha Liberty Mutual. You might not have ever thought that word mattered, but that word mutual is a very important word. So we're going to talk about the different types of insurance companies. I'd focus heavily on stock, mutual, and fraternal. If you're in property and casualty, you can also learn surplus lines, but we will discuss them all. A stock insurance company is owned by its stockholders. We'll come back to that. A mutual insurance company is owned by its policyholders. Come back to that. Next word we have is a dividend. If you currently know the definition of a dividend, and you've learned it from, say, financial classes in college or just investing in general, I'd like for you to forget your definition of a dividend. We have to learn a new definition of a dividend. A dividend is considered a return of excess premium. It's also known as a refund. Dividends themselves are considered tax-free. So remember, if you currently think you know what a dividend is, you have to change that definition for this test. Now let's talk about the different types of insurance companies. Stock insurance companies does not mean that they are on the stock market. It means that that company was typically set up as an incorporation, and they have shares that they give out to their board of directors, their officers, the owners. So let's say you have a stock insurance company. And let's say that stock insurance company has two owners. They charge all of their policyholders $100 a month. If this stock insurance company has a good year, dividends will be paid to these owners. The policyholders will remain the same. They separate the profit making of the insurance company from the policyholders and the owners. These dividends from stock insurance companies would have been considered taxable, but we don't talk about them on the test. We'll be talking about dividends from mutual companies in just a second. If this stock company needs to make money or needs to expand, this stock insurance company, if it has 100 shares, can sell stock and get more investors. The policyholders will continue to pay their $100 a month. Everything stays the same. Mutual companies don't work that way. Mutual insurance companies are owned by the policyholders. So every person that buys a policy from a mutual insurance company, they're actually an owner in that insurance company. So if a mutual insurance company charges everybody $100 a month and they have a good year, the mutual insurance company will pay a dividend to those policyholders. Those policyholders have voting rights. They own that company. So if you have an insurance policy through a mutual company, you actually are an owner in that company, and you're entitled to these dividends. Now, if a mutual insurance company has a bad year, they're not going to have any extra money to give to the policyholders. So dividends are not guaranteed. A dividend is kind of nice. If they have a good year, you get some money back. If they have a bad year, you don't get any money back, and your rates will typically go up. If a mutual company wants to expand, they can't sell stock because they don't have any stock. They'd have to sell more policies. Or they'd have to increase rates on their current customers. And that's usually what happens. Mutual insurance companies are typically more expensive than stock companies starting out. But if that mutual insurance company has a good year, they can pay that dividend to that policyholder, and they might be cheaper at the end of the year. So you might have heard of, say, a good driving discount. If you have a good driving record for, say, 2 or 3 years, the insurance company could waive your deductible. That's a mutual insurance company. And that waiving of the deductible would be the dividend. Dividends are not always considered checks. You don't always receive money for them. Dividends are tax-free because what they're doing is they're saying, we charged you extra money up front. And since we had a good year, we're going to give you some of that money back. It's not considered a profit. It's just a return of excess premium, also known as a refund. They're saying we charged too much, here's some money back. Some people like to consider dividends an overpayment of premiums because you're not actually profiting, you're just receiving some of the money back. So dividends are refunds. Dividends are tax-free. Dividends are paid out once a year, and they are not guaranteed. Now, between the word stock and mutual, which one would you consider as participating? Which one would you say the policyholders are participating in that insurance company? And I'd say mutual. Mutual insurance companies are also known as participating companies because the policyholders participate in the running of the company. Stock companies are known as non-participating because the owners and the policyholders are two separate people. The CEO of a mutual company actually has to own a policy from that mutual company, whereas stock insurance companies, all you have to do is buy stock. Stock is known as non-participating. Stock companies pay dividends to stockholders. Stock insurance companies are managed by a board of directors. Mutual companies are known as participating. Mutual companies are managed by a board of trustees and are owned by the policyholders. The policyholders receive dividends in mutual companies, and those dividends are tax-free because it's considered a refund of premium. For life insurance, dividends are typically used to increase the coverage. So let's say you had $100,000 death benefit today. Your life insurance company had a good year. They could give you, say, a $50 dividend. But instead of receiving the $50, you use that $50 to increase your death benefit to, say, $110,000. So dividends are usually not paid in cash. They're typically used to increase coverage or remove deductibles and other aspects. Dividends are not guaranteed. As a producer, you may be representing a mutual insurance company, and you must tell your customers that dividends are not guaranteed because they'll see these as a perk, and they are. It's very nice to be a part of a good, working, well-managed mutual company. Dividends will just start rolling in. But if, let's say, management changes, those dividends could stop because that mutual company could start losing money. So it is important, if you represent a mutual company, to tell your customers that dividends are not guaranteed. Stock companies don't have to worry about that because stock companies' customers do not receive dividends. The stockholders are the ones who receive dividends from a stock company. So this is just a little illustration here. Stockholders are paid dividends from stock insurance companies. Policyholders are charged, say, the same amount, and they receive the same amount. Mutual insurance companies are owned by those policyholders. There are no stockholders, so mutual insurance companies pay dividends to the policyholders. So the mutual company could end up a little bit cheaper in the end, but it always starts out more expensive. It's kind of like a co-op. If you have a good year, everybody does well. Dividends are paid tax-free on an annual basis and are not guaranteed. The next type of insurance company that we have is called a fraternal organization. Fraternal organizations are owned by members of the organization. So you might have heard of the Fraternal Order of Police. If you're not a police officer, you cannot buy insurance from the Fraternal Order of Police. So fraternal organizations are kind of like exclusive clubs, like a credit union. You have to be a member in order to obtain coverage. The next type of insurance company is called a reciprocal exchange. This is actually rather complex. A reciprocal exchange is set up by an attorney in fact because the insurance companies do not get incorporated. So, as of 1956, all insurance companies are regulated on a state basis, meaning that they have to get licensed and registered in each state, and insurance is a state regulated product. But that only applies to insurance companies who are incorporated. So some insurance companies that insure niche situations, they choose not to get incorporated and act as sole proprietorships, which increases their risk of liability. Those are known as reciprocal exchanges. None of that's important for your test, but since they're not incorporated, they must have an attorney in fact who runs that sole proprietorship. They typically only sell liability insurance, and it's for higher risk property and casualty business. You will likely not see a reciprocal exchange on your test. The next type of insurance company is called a Lloyd's Association. You may have heard of Lloyd's of London. Lloyd's of London insures anything. So you might have heard of, say, Madonna insuring her voice, or a quarterback insuring their arm. Lloyd's is what insures that. Now, Lloyd's of London is actually illegal in America. We call them Lloyd's Associations, and I'll explain the difference. Lloyd's of London originated in France, and Lloyd's of London was an auction for insurance. So if you had something high risk, you would actually go up for an auction, and multiple insurance companies would bid on your risk. So let's say you had a risk of, say, $100,000. One insurance company would say, I'll take on 40% of that, but you'll have to pay me $100 a month. Another insurance company would say, well, I'll take on another 40%, but you'll have to pay me $200 a month. And then a third person will come in and say, I'll take on the last 20%, but I want $500 a month. You're now insured through 3 insurance companies. Lloyd's cannot operate in America. We do not auction insurance in America, and they don't auction insurance anymore across the pond. We call them Lloyd's Associations, which is where you're insured by multiple insurance companies, but instead of them bidding for your risk, they just have set rates. So Lloyd's of London are an unincorporated group with individual underwriters, and Lloyd's Associations are allowed in America. Not Lloyd's of London, not an American Lloyd's, but a Lloyd's Association is allowed in America. The next thing we have is a risk retention group. This is where similar businesses go in together to self-insure. So that would be like a lot of lawyers saying, hey, we need some malpractice insurance, but the rates are too high in the standard market. So let's band together and create our own insurance company. So risk retention and purchasing groups must be similar lines of business. You can't inject a construction company into a lawyer's risk retention group. It has to have similar risk levels. Not a big deal. Next type of insurance company is called a self-insurer. That is what Walmart does. That is what state governments do. That is what the federal government does. That is also what large retailers such as Kohl's, IKEA, large companies self-insure, meaning that they do not have an insurance company that pays claims. The claims come out of their pocket. They typically hire somebody called a third-party administrator to handle the claims, but the actual claims reserves themselves, the money for those claims, come out of the company's pocket. The next word is called surplus lines. If you're going into property and casualty and you're doing commercial insurance, you'll likely deal with surplus lines. Surplus lines is an excess market. It's a secondary market for higher risk customers. So let's say you want to insure a fireworks manufacturer. Standard insurance companies aren't going to want that fireworks manufacturer. It's too high risk. So they would go into surplus lines, which is a regulated market, but it has less regulation than the standard market. These insurance companies you may never have heard before, such as Colony, Markel, Essex. These insurance companies insure higher risk, but they also charge higher premiums. These companies are known as non-admitted, also known as unauthorized companies. We'll learn unauthorized a little bit later on, but just because they're unauthorized surplus lines does not mean that they are bad news. Surplus lines is a needed area, and it's where the higher risk people can get insurance. The only downside of a surplus lines company, other than the price, is that if the surplus lines company chooses to deny claims and you try to appeal to the state government for help, the government will say, we did not authorize that company to do business within this state, so you're on your own. You'd have to sue the surplus lines company yourself. If you're a producer and you represent the surplus lines company, you can actually be sued for the actions of your insurance company. You assume a portion of the liability for representing a surplus lines company because it's a less regulated market. Now, most insurance agents, about 95% of insurance agents, will never deal with surplus lines. If your standard market insurance company, say State Farm, decides to deny claims, you as a producer have nothing to do with that. But if you go with one of the surplus lines companies, you're on the hook for any of those actions because it's a less regulated market. These companies do not receive something called a certificate of authority, which we will talk about in a little bit. Next words we have are social insurance, also known as government, versus private insurance. Social insurance programs are government insurance programs. That's such as Medicare, Medicaid, Social Security. We also have social insurance programs in property and casualty, such as flood insurance, crime insurance, ocean insurance. The difference between government insurance and private insurance is that government insurance is funded by taxes, whereas private insurance is solely funded by premiums. So our social government programs are funded by taxes, whereas the private insurance companies, they don't receive tax dollars. Next thing we have is the Department of Insurance and Commissioner. We learned a little bit earlier that insurance is regulated on a state level. The first insurance company in America, first real insurance company, was set up by Benjamin Franklin. It was called the Philadelphia Contributorship Insurance Company. And since Ben Franklin's first insurance company, it's gone to the Supreme Court 7 times. And out of those 7 times, it's been upheld as a state-regulated product 5 times. So that's why we don't sell insurance across state lines, because we have states' rights issues where the states retain control over insurance. So every state has their own Department of Insurance, and the person who heads that Department of Insurance is known as the Commissioner of Insurance. Each state has a different name for their Department of Insurance. Your test will just call it Department of Insurance. But anytime I say Commissioner, I mean Department of Insurance. Anytime I say Department of Insurance, I mean Commissioner. If you ever have a complaint about an insurance company or an insurance agent, you can call up your Department of Insurance and they'll help you get that sorted out, unless it's a surplus lines company. When you get your license, you're going to apply through your Department of Insurance, and they will be the ones who regulate you. If you get caught doing something wrong, the commissioner will have a nice little sit down with you and you discuss, what are you doing? So this is the regulatory body. The commissioner's primary job is to advise the governor on state insurance laws. She also educates the public and regulates insurance companies. And she also sets procedures for the Department of Insurance. She has a very busy job. Now, she doesn't sell insurance. The Commissioner of Insurance just regulates insurance. She's like the figurehead. Typically, they rotate every 2-4 years, depending on the state. So, here's our commissioner. Here's our Department of Insurance. The Department of Insurance regulates those agents and producers and educates the public. The insurance commissioner is also a member of something called the National Association of Insurance Commissioners. Since insurance is a state-regulated product, there has to be a way for all the commissioners to talk. The NAIC, National Association of Insurance Commissioners, creates uniform rules and procedures across state lines. The NAIC is not a government body. All of the commissioners decided to come together and said, hey, let's talk. Let's create it so that insurance is very similar no matter where you go. This is the reason why if you get into a car accident in Florida, it's very similar to a car accident in Texas. Or if you buy life insurance in Utah, it's very similar to buying life insurance in Connecticut. The NAIC comprises of all the commissioners, and they typically have 2 meetings a year. And they try to set rules and regulation that needs to grow with the market. So recently, they've been talking about texting and driving because the insurance industry wants to start banning it and denying claims. But they don't have a good definition of texting. So the commissioners talk, and they haven't quite come up with a solution for it yet. But when they do, every state will likely use a very similar texting and driving rule. You're going to learn that every policy has something called a grace period. And that gives you extra time to pay your bill. In most states, it's 31 days. But different states can set different numbers. But every state will likely have the grace period included in every policy. That's because the National Association of Insurance Commissioners created that uniform rules and procedure. We'll talk more about that as we get further along. Now, the NAIC is not the government, and it has no legal power. Now, these next words are rather important. We have the words authorized, also known as admitted, and we also have non-admitted and unauthorized. An admitted, also known as authorized insurance company, can transact insurance within the state. A non-admitted, also known as unauthorized insurance company, cannot transact insurance within the state. Do you remember what unauthorized companies were called just a few minutes ago? Surplus lines. Unauthorized companies are known as surplus lines, and unauthorized companies do not have a certificate of authority. So the insurance commissioner gives a certificate of authority to authorized companies. That allows those authorized companies to transact insurance within the state of Texas. When she gives that certificate of authority to the authorized companies, she really just has a couple questions. How much money does the insurance company have? What type of products are they selling? Do they have a good financial rating? Do they have any complaints? As long as the insurance company is financially solvent, putting out good products, no real complaints, and there's a need for that insurance in the state, she will give that certificate of authority to that authorized company. Then they can transact business, which means to collect premium, issue policies, explain provisions to customers. But if they're insuring higher risk things, where they don't have enough money, that unauthorized company did not receive that certificate of authority. That unauthorized company cannot transact insurance within the state. If a producer represents that unauthorized company, the producer is liable for the acts of that unauthorized company. That's also known as surplus lines. Now remember, surplus lines is not a bad industry. Surplus lines is a needed thing, but it's for higher risk people. It is regulated, just not as regulated as the authorized companies. The next thing we're discussing is where an insurance company is incorporated. Now, we're going to just say this is where their headquarters are to make it a little bit more simple, because some states could be headquartered in, say, Texas, but incorporated in Delaware. We're just going to say they're incorporated and headquartered in the same state to make learning an easier process. A domestic insurance company is chartered and incorporated within the same state you're currently in. So I'm based out of Texas, and any insurance company that is chartered and incorporated in Texas is domestic. An example would be USAA. They insure a lot of military members. USAA's headquarters is in San Antonio. So therefore USAA is domestic to me. A foreign insurance company is incorporated in another state. Foreign does not mean country. Foreign means another state. And a foreign insurance company would be any other state than Texas, where I'm currently at. So to give you an example, Aflac is based out of Columbus, Georgia. Aflac is domestic to Georgia, but foreign to Texas. Alien insurance companies are incorporated in another country, like France, Mexico, Cuba, Canada. Some other countries can still be foreign, such as Puerto Rico, because Puerto Rico is a United States subsidiary. We consider them foreign. But Cuba is completely on their own. That's alien. So Guam, Puerto Rico, Washington, D.C., they're still foreign, but other countries that are separate sovereign nations, they are alien insurance companies. Now, I have a question for you. Which of these insurance companies can transact business within the state? Is it domestic, foreign, alien, or authorized? And the answer is authorized. Because remember, to transact business, which meant to collect premiums, means that that company has a certificate of authority. And an authorized company can transact business within the state. There are domestic authorized companies. A domestic authorized company means that they're headquartered in Texas or wherever state you're located, and they do business within that state. They have that certificate of authority. But you can also be domestic and unauthorized, meaning that you're headquartered in your state, but you don't do any business in your state. You can be foreign and authorized. That means you're from another state, and you do business in this state. That would be such as Aflac, headquartered in Georgia, but also transacts business in Texas. You can be foreign and unauthorized, meaning that you're from another state and you don't do business within this state. You can be alien and authorized, alien and unauthorized. So domestic, foreign, and alien mean where their headquarters are, where they're incorporated, whereas authorized and unauthorized means whether or not they can actually sell insurance within that state. Next thing we're discussing are called financial rating companies. Financial rating companies are kind of like the credit rating agencies, but they're used for businesses. We have AM Best, Standard & Poor's, Wise, Moody's, Fitch. These are all insurance company rating. They give credit scores such as A+, A-, AAA, AA. These are financial rating companies that give credit scores to insurance companies. In the insurance world, we really only care about an AM Best. As long as an insurance company has a, say, B or above AM Best rating, we'll typically don't mind selling their policies. But once they go below B, You have to think hard if you actually want to represent that company. So financial rating companies rate the financial strength of a company, and they're known as AM Best, Standard & Poor's, Moody's, Fitch, and Wise. We'll talk more about the Securities and Exchange Commission a little bit later. Now, the next thing we're talking about are the different ways insurance companies sell their products. And the way insurance companies sell their products are through you, insurance agents. The two primary types of insurance agents are captive and independent. A captive agent only represents one insurance company or a group of insurance companies, such as subsidiaries. That would be an example of, say, State Farm. If you sell State Farm insurance, you're only allowed to sell State Farm insurance. Now, State Farm might enter into a contract to sell, say, Aetna Health Insurance, but everything else is going to be State Farm. If that agent wants to sell Progressive Insurance, they can't. They want to sell United Healthcare Insurance, they can't. They're captive, they're stuck. Independent agents can represent any insurance company except the captive insurance companies. So as an independent agent, you might be able to sell Blue Cross Blue Shield, United Healthcare, Progressive, Aflac, Traveler, Safeco. Independent agents typically sell multiple types of insurance in multiple insurance companies. Now, captive and independent are not two different types of licenses. The license you're obtaining allows you to sell either captive or independent insurance. This is just who you go to work for. If you went to work with State Farm, Allstate, Nationwide, Geico, you would be captive. But if you represented Traveler, Safeco, Progressive, and some other companies, you would be independent. So captive agents and independent agents have the exact same licenses. They just work with different insurance companies. A general agent, sometimes known as a managing general agent, is kind of like the liaison for the insurance company and the insurance agents. Their job as a general agent is to recruit agents. Sometimes they recruit 5,000 people a year. And the general agent's job is to train all of these agents. And each time an agent sells a policy, the general agent earns commission. So let's say you have 5,000 agents underneath of you, you might earn 1% commission on every single one of them. And your job is to make sure that they have adequate training, and your job is also to help them to advertise. General agents earn commission, but are also reimbursed for certain office expenses, such as marketing material, hiring practices, and other office expenses, such as computers. General agents do not sell insurance. They just appoint agents, train agents, and are the liaison. They're still independent, though, meaning that they do not work. They are not an employee of the insurance company. They're still a 1099 contractor, just like general, independent, and captive agents. The next type of agent is known as a managerial agent. I call managerial agents marketing reps. A managerial agent is an actual employee of the insurance company. And they typically work with the general agents and sometimes the independent and captive agents, and they try to get you to increase your sales. Managerial agents have an actual office at the insurance company's headquarters, and they earn a salary, and they also earn a bonus. Managerial agents, just like general agents, do not sell insurance. Managerial agents just make sure that the entire state or the entire territory that they're managing is profitable. You usually don't see a managerial agent more than once or twice a year. You might get a phone call from them and saying, hey, how's business going? The managerial agents, they do not sell insurance. They just earn salary and bonuses as long as that state or territory does well. The last type of agent is called a direct agent. A direct agent is typically a call center employee. It's when the insurance company sells insurance directly to the public. That's like Geico used to be. Geico did not have offices, so you didn't actually have an agent with Geico. Geico was your agent. They were selling directly to the public themselves. Now Geico started opening up offices, so they also have direct and captive agents now. Insurance companies used to sell insurance through vending machines. I'm not old enough to see that, but back in the 70s, if you were going to fly across the country, you could buy a life insurance policy just to cover you for that one trip. That vending machine was a direct agent, even though it wasn't a person. Buying insurance through the computer or through a television ad or through a call center is a direct agent. So captive represents one insurance company or a group. Independent represents multiple insurance companies. General agents recruit agents and earn commission off of them, but don't actually sell. Managerial agents earn salary and bonuses. Managerial agents head up an entire territory, and they're an employee of the insurance company. And direct response is where the insurance company sells directly to the public. Now, we learned a little bit earlier that as a producer, your job is to make sure the insurance company makes money. That's known as the law and rule of agency. As a producer, you do not represent the customer. You represent the insurance company. But you still want to keep the customer's best interest in mind, but if it came down to it, you always have to back the insurance company. If you're acting ethical, you are always making sure the insurance company is informed of everything that's on an application. As a producer, when you get appointed with an insurance company, you will gain 3 types of authority. The first type of authority you will receive from the insurance company is called express. Express authority is written contract with your insurance company. So to get appointed, you're going to sign a contract, and it's sometimes long, sometimes short, depends on who you're representing. But your contract will expressly write what you can and cannot do. It will say, you can sell insurance using our name, and we're going to pay you this commission. You can sell these products and within these states. It's an expressly written, stated contract. Implied authority is a contract that is not in writing. When you get appointed with an insurance company, you will also gain this type of authority because the contract can only be so big. It can't say everything. Your express contract might say you can collect premium, but it's implied you can collect $10 from Billy Bob, $20 from Sue Bob, and $30 from Joe Bob. So implied authority is a non-written contract, and that's like where you make phone calls. Most of an insurance agent's beginning months are going to be making phone calls, trying to drum up business. Your contract doesn't say you have to make phone calls. It's implied that you can make phone calls. If you want to get some business cards printed up, since you represent that insurance company, you can get some business cards written up. The last type of authority is known as apparent. This is kind of like the gray area. Apparent authority is the appearance of authority. It's what a customer thinks you can do, but you may or may not actually have the authority to do that. So do you remember who actually sets the price of a policy? That would be the underwriter. The actuary was the one that sets the prices for the entire company, but the underwriter is the one that sets the prices for the actual individuals using the actuary's information. The producer does not set prices. Customers might think you can. It appears to them as if you have the authority to actually issue the policy, set the price, but you do not have the authority. That's through the underwriter, that's through the actuary. Apparent authority would be such as having a sign up. If you have a sign, the customer thinks you represent that company, and you probably do. But maybe you just decided not to work there anymore. It appears to them as if you have the authority, but you now don't. Insurance companies typically do not like it if you put their name on your vehicle, because the customers will think that you actually have more authority than you do. So business cards are fine, but don't go out and get your truck wrapped unless you check with the insurance company. Apparent authority is when you use training material, sales material, rating material. The insurance company the customers think that you have the authority to do all of this stuff, when in reality, you're just taking information, submitting it to the underwriter, and then relaying that information back to the customer. So express is written, implied is not written, but what you need to do to get your day-to-day job done. And apparent is what the customers think you can do. A lot of customers are going to ask you for a discount, and you can only give them discounts they're entitled to. Sometimes there's no discounts, but they don't mind asking. So the next thing we're going to learn are elements of a legal contract. These not only apply to every insurance policy out there, but it also applies to every contract out there. And contracts are not required to be in writing, but insurance contracts are. So let's say I offer to mow your lawn for free, and I don't mow your lawn. We don't have a contract because I offered to do it for free. You have to have these 4 metrics for any type of contract. There must be an offer and an acceptance. That means both parties must agree on what's happening. There must be an exchange of monetary value. That's known as consideration. Consideration means money. Now, it doesn't actually have to be money. I could mow your lawn as long as you cut my hedges. But there has to be an exchange of value between the two people. All parties must be competent. So you have to be of age, sane, and sober. And all contracts must abide by the law. It has to have a legal purpose. So the offer is satisfied when the applicant fills out an application and offers themselves up to the insurance company. Then the insurance company accepts that person. Now, insurance companies market their products to everybody, but they don't have to take everybody. The way I like to remember this is that the insurance companies, they have advertisements everywhere, and the customer applies. No matter how much that customer wants the insurance policy, if the underwriter doesn't accept them, customer will never get insurance. So the applicant makes the offer by filling out the application. The acceptance is when the underwriter accepts that risk. Then you have to exchange money. That's consideration. The insured pays their premiums, and on your state exam, the insurance company promises to pay claims. Everybody's competent. You can't be drunk. You can't be crazy, and you have to be over the age of 18. Some states have different laws. We'll just go with 18 to be easy. And all contracts must abide by the law. Here's an example of a state exam question. All of the following are elements of a legal contract, except offer and acceptance, consideration, negotiation, legal purpose. And negotiation is not part of a contract. We don't negotiate people. A few slides ago, I said that customers are going to ask you for discounts. We cannot give them discounts that they are not entitled to. There is no negotiation. The prices are set by the actuary, enforced by the underwriter. That's because all insurance contracts are known as contracts of adhesion. A contract of adhesion means that there is no negotiation. The insured can either take it or leave it. That means that the customer cannot go scratching things out. If they want to change the wording, they should just go to another insurance company. So contract of adhesion means that there is no negotiation. The insured can take it or leave it. Now, the insurance companies are very smart. They have teams of lawyers, lots of them, and they're very, very, very good. If an insurance company has an ambiguous contract, that means unclear or vague, it contradicts itself, or you're not sure what it says. So if an insurance company has an ambiguous contract and it harms an insured, who do you think would win that lawsuit? And the answer is actually going to be the customer, the insured. Because the insurance company wrote the contract, they have the duty to make sure that contract is clearly defined. Let's say an insurance company insures all men except people named Joe. So I apply for insurance. I'm approved. Then I file a claim. That insurance company would likely deny the claim. They would say, hey dude, your name's Joe. You're not getting coverage. But I'd show them my driver's license. And my driver's license says Joseph. And I actually prefer Joseph as my name. That's what my friends and family call me. The insurance company would likely still deny that claim. But if I sued, I would win because they never described Joe means Joseph. So if an insurance contract of adhesion is ambiguous, the customer will win because I never got a say up front. I said, hey, my name's not Joe, I'm Joseph, so I bought the policy. But the contract was unclear, so I'm going to win. The next definition we have is called an aleatory contract. An aleatory contract means a contract that is unequal. That's where the customer pays a little bit, but they're insured for a lot. Term life insurance can be bought as cheap as $10 a month for $500,000 in coverage. That's aleatory. Now, how does this company make money? Because, I mean, $10 a month, that's $120 a year. If they buy insurance for 10 years, it's $1,200 a year. You buy insurance for 100 years, it's only $12,000 a year. How's an insurance company making money if they're charging so little, but they're insuring people for a lot? And there's a lot of factors that go into this. First of all, term life insurance, that's short-term coverage. Term life insurance only pays out on around 2% of claims because the policies typically expire before a person dies. Term life insurance is also extremely cheap because it doesn't really do anything. The person has to die, it's not going to be there, it doesn't have cash value, there's no other claim than death that it covers. So what the insurance companies do is they take these premiums from everybody, not just that one person, but everybody. The insurance company then invests those premiums, and they earn interest. They're going to double this $10 a month over and over and over and over. So they're making all of their money on interest. Then they'll likely never pay out this $500,000 on the 98% of policies, so they've done a pretty good job. Now, if more people die this year, rates will have to go up, but it's still never going to equalize because insurance companies are using this money to earn interest. Insurance companies earn their profits through interest, which helps lower rates. So it's a good thing that insurance companies can invest this money, or else we'd all have to pay a lot more claims. So aleatory means the exchange of unequal amount. That's where a person pays a little bit, they're insured for a lot. The way I remember this is a contract of adhesion is like glue. It's stuck. You can either take it or leave it. And then I look at the word aleatory and I think of two things. First, I think the word has too many vowels. So I say it's unequal in vowels. But I also look at it and I think of alimony. And alimony is unequal. Typically, one person pays more than the other person. Aleatory is the exchange of unequal amounts. That's how I remember it. The next type of contract we have is a personal contract. This is just where a person is insured. Not a big deal, so we won't spend much time on that. Next word we have is called unilateral. Unilateral contracts mean that they are one-sided. That means that only one party is required by law to uphold this contract. So if you buy insurance, any type of insurance, the policy owner can cancel it at any time they want. But the insurance companies cannot. They cannot just call you up and say, hey, I know we insured you, but I'm not really feeling it today. I think I'll just drop you. The insurance companies are required by law to abide by that contract, but the customer does not have to. Only one side has to abide by that law. So the easy way I remember this is uni means one, because I think of unicycle, and unicycle is a one-wheel bike. And lateral means sideways, so I think of a one-sided contract. And I also read that as unilateral. That way I remember that the law only applies to one party. Every insurance contract is unilateral because a customer can cancel anytime they wish. Insurance contracts are also conditional, meaning that you have to meet certain conditions to either be insured up front or to continue coverage. And the insurance company also has conditions. They must send you a bill. You must pay that bill. A conditional contract could also be a small employer health plan. Small employers are considered between 2 and 50 employees. If that small employer got 51 employees, they would be dropped. If they had 1 employee, they would be dropped. They must meet conditions. Next word we have is reasonable expectations. This is a true story. I'm not making it up. One day, a guy bought an RV. The RV salesman told him that the RV had cruise control. It basically drives itself. So when they were closing on the deal, the guy had to present his insurance, and he told the salesman that he has full coverage. No problem. His agent tells him, you have full coverage. No problem. So the guy buys the RV, takes it out on the road, gets on the highway, sets it on cruise control, basically drives itself. Guy gets up out of the seat, goes to the bathroom. What do you think happened to the RV? That guy tried to file a claim and was initially denied because his policy states if a vehicle is in motion, there must be a person driving the vehicle, and he was not driving the vehicle. But he stated, you sold me full coverage. A person can reasonably expect that everything is covered with full coverage, even though the insurance company specifically excludes it in the contract. Their marketing material still holds them liable. So that guy had to be paid out because he had full coverage. Now, no good car insurance agent will ever say the words full coverage anymore. We all say other than collision and collision because you don't feel like everything's covered. You feel like other than collision and collision's coverage, you're not fully covered. So reasonable expectations is where an insurance company must still abide by a claim as long as the customer could reasonably expect coverage. The next definition is called indemnity. Indemnity is the entire foundation of insurance. It's one of the most important words in the insurance industry. Indemnity is to be made financially whole in the event of a claim. So if I got real angry and I went down and kicked a dent in your car, would the insurance company buy you a new car or would they fix the dent? They would fix the dent. That is called indemnity. So indemnity will pay out up to the policy limits, no more than the policy limits, or below the policy limits, depending on how much the damage is. Our job is to make sure that people are indemnified. This is why car insurance for collision and other than collision is known as actual cash value. Because if you wrecked a 10-year-old car, a new car is going to cost you $30,000. but they're only going to indemnify you because you have wear and tear on the car. So you're only going to get, say, $7,000 because that's just making you financially whole with where you were. All insurance contracts are also written in the utmost good faith. That means each party has to trust each other. You trust the insurance company will pay claims. They trust that you are not lying to them. The next words we're going to learn are representations and misrepresentations. A representation is a true statement to the best of your knowledge. A misrepresentation is an untrue statement. Representations are statements that are made on the application. When you ask a customer their information, sometimes they're wrong, but they're doing the best job that they can. They're trying to relay as much truthful information, so that's known as a representation. But if that person lied to you, just flat out lied, that would be a misrepresentation. When a customer signs the application, they have to state, these are my actual representations, and as a producer, we have to sign the application to state that these are the representations that were made to us. So if an insured was asked when the last time they were at the doctor, and they responded, April. However, they forgot in reality that it was May. We still would treat that as a representation because they thought it would be true. A misrepresentation would be saying, I've never been to the doctor at all. A warranty is an absolutely literal statement. Warranties are guaranteed to be true. Very few warranties are ever made by customers. The warranties are typically made by the insurance company. The insurance company guarantees that if you have a claim, that it will be paid out. Of course, it has to be a legitimate claim. Some warranties could be, say, you have a burglar alarm, and you ensure that you will always have that burglar alarm on. Another warranty could be when you have to prove the good driving discount. You guarantee that you currently had B's in school. So warranties are absolutely literal statements. They are guaranteed, backed by the insurance company typically. Concealment is when you hide information. It's not really lying, but you're not upfront and forthcoming. So concealment could be when you ask a person, have you ever had an accident? And they say, no, I've never been in an accident. That'd be a lie. But if they say, oh, I'm not sure, how about I get back to you? And they never get back to you on it. That would be concealment. Concealment could be when you try to insure somebody and you go through all of the application questions and they seem healthy, everything seems kosher, but that's because you didn't ask them specifically, such as, do you have cancer? You might have said, are you healthy? And they say yes, but you never asked them about cancer, and they know they should tell you, but they decided not to say that. Fraud are considered material misrepresentations. Fraud is an intentional and knowingly, deceivingly an insurance company or a person for financial gain. If it sounds like fraud, it's probably fraud. Stealing, embezzling, false financial reports, we all consider that fraud. These next words, I think they're kind of cool. Waiver and estoppel go hand in hand. Contracts have rights in them that outline what you can do and what you can't do. Sometimes you can ask the insurance company to bend the rules a little bit. Let's say your bill's due in 10 days and you have a grace period for 30 days after that. You call them up and say, hey, I'm not even going to be able to get it in during the grace period, but if you just wait 2 more days, I can get it in 2 days after the grace period. Just please don't cancel me. So they give you all that extra time, the extra 2 days. But you file a claim between the date it was supposed to lapse and the day you were supposed to pay. The insurance company would have to pay that claim because they gave you that extra 2 days. They created a waiver of the 30-day grace period by giving you an extra 2 days. They're then estopped from trying to get that right back. This is why insurance companies typically don't work things out with a customer. They have to go by exactly what the contract says, because if they make a waiver, it could come back to get them, and they don't want that to happen. They don't want to be stopped from invoking that right. Now these are going to be some federal regulation laws. They will likely be on your test, maybe not all of them, but the Fair Credit Reporting Act is pretty much always there. Anytime you see an A at the end of something, that typically means that it's federal regulation enacted by Congress, because that A means act. The first federal act we're going to learn is the Fair Credit Reporting Act, and it provides consumers protection for what is used in their credit report. Back in the day, insurance companies used to be able to use anything to underwrite you. They could talk to your friends and family. They could deny you coverage because you didn't pay your telephone bill. They could pretty much do anything they wanted. But the Fair Credit Reporting Act not only regulates banks, mortgages, and auto loans, but also regulates insurance companies. If there's ever incorrect information on your credit report, there is a method to fix it. Typically, it's through certified mail. If you ever have any questions about how to get something off your credit report, feel free to email me at joe@texasinsurancetrading.com, and I'll send you some information to make it a little bit easier, because there is incorrect information on your credit report. The two types of reports we use in insurance are called consumer reports and investigative consumer reports. A consumer report is a soft pull of credit. It doesn't hurt their credit score. It's just an inquiry. If a person has good credit, they typically get lower rates. If they have bad credit, they typically get higher rates. But we don't decline people because of their credit scores. When we pull people's credit, we typically notify them at the time of application. But we do have up to 3 days later. But we almost always notify them at the time of application, hey, we're pulling your credit. This is what it's used for. Don't worry. If their credit report adversely affects their insurance rates, we send them a letter within 5 days detailing why. Now, as a producer, you don't write the letters. The insurance company writes the letters. The other type of consumer report we'd use is called an investigative consumer report. This is more in detail. If you're going into home and auto, property and casualty, you might be asked to actually physically inspect a property and take pictures. That's an investigative consumer report. If you're going to life and health and you insure somebody for a lot of money, the insurance company might want you to find out the person's hobbies, habits, and reputation in the community. Because if you're insuring somebody for, say, $30 million, that's a high risk. So an investigative consumer report is a more in-depth investigation. We don't find any medical information here. We just look into them, their background, what's going on. Whenever we order information, we also have to give the customer a disclosure notification authorization. The insurance companies typically give the disclosure notification authorization for us, but it's just to notify them, hey, we're pulling your credit. That way, as a producer, if we tell them, they really understand because it's in writing. These court cases are likely not on your state exam, so we won't focus too much on them. But first one, Paul versus Virginia, insurance was not considered interstate commerce, so it was an insurance state-regulated product. Then the United States Southern Underwriters, insurance was considered interstate commerce, so the federal government could regulate it. Then the McCarran-Ferguson Act took it back and said, no, insurance is going to be regulated on a state level. Then in 1958, we upheld the McCarran Act, and then we have the SEC Act and the Patient Protection Affordable Care Act. Insurance is still going to be considered a state-regulated product, but it can have some interstate commerce into it. Not a big deal about this. The next act we have only applies to life and health insurance. This is known as COBRA. The real name of COBRA is the Consolidated Omnibus Budget Reconciliation Act. COBRA applies to companies that have 20 or more employees, and if they offer health insurance, it allows the employee to continue that health insurance after they've left their job. They could have been fired, quit, laid off, whatever it is, the person can continue that group health insurance for up to 18 months after their job. Now, a lot of people say that COBRA is expensive, and it feels like it is, because when that employee worked with the employer was paying most of the premiums. But if the person no longer works there, the employer is not going to keep paying part of the premiums. That individual would be required to pay 102% of those premiums after they left their job. So you work for a company, your employer paid some premiums, your employer was paying $300 a month, you were paying $100 a month. Then the person lost their job. The person would have to pay 102%, which would be the $300 plus the $100 plus an extra $8 for a total of $408 for a maximum of 18 months. COBRA is not new insurance. It is not government insurance. It is the same insurance plan that they had. If the company goes under, goes bankrupt, or decides to just not offer health insurance anymore, that employee could not continue coverage because COBRA is only the continuation of coverage. So some employees, when the company goes bankrupt, they don't have any health insurance at all after that. This act is not a big deal. The Financial Services Modernization Act, we're not going to get into it. The next act we have is called the USA Patriot Act. The Patriot Act applies to terrorism. The reason why it could be on your state exam is because insurance can be used to give money to terrorists through money laundering. So the Patriot Act, enacted right after September 11th, helps regulate anti-money laundering. The next act is called ERISA, the Employee Retirement Income Security Act. This states that employers have a fiduciary responsibility to protect funds in retirement accounts. Your employer cannot steal your money from your retirement account, or they could have some legal repercussions. So ERISA just states that the employer has a fiduciary capacity. If you don't know what the word fiduciary means, that means money handling trust capacity. As a producer, you will also be a fiduciary. People are going to give you money. They're going to trust you to send that up to the insurance company. Cashiers are also fiduciaries. Banks are fiduciaries. So ERISA states that an employer has a fiduciary responsibility to employees' retirement accounts. And the last act that we really care about is known as the Affordable Care Act, aptly named the Patient Protection and Affordable Care Act. The Affordable Care Act was enacted in 2010, and it'll fully go into effect in 2020, with the bulk of the bill going in 2014 to 2016. The Affordable Care Act made all health insurance guaranteed issue. That doesn't apply to life insurance, disability insurance, or supplemental insurance. It only applies to comprehensive health insurance. And that means that no person will have any pre-existing condition exclusions or medical underwriting for comprehensive health insurance plans. The Affordable Care Act establishes exchanges on either the state or the federal level, kind of like the Travelocity of insurance. It's where a person can go on healthcare.gov, pick an insurance plan they want, and there's going to be a list of, say, 50 different plans. Based off of that person's income, they may also receive a subsidy. The subsidies range between 100% of the federal poverty limit and 400% of the federal poverty limit. So the federal poverty limit for an individual in 2015 is roughly $12,000. So if a person earns between $12,000 and $50,000, no family, just the one person, they could receive a subsidy under the Affordable Care Act. A family of four is roughly $25,000. So they would receive a subsidy between $25,000 and roughly $100,000 or so depending on how large the family is, which that was based off a family of 4. It also states that there are no longer maximum lifetime limits. Health insurance plans used to have, say, $1 million maximums for back surgeries, cancer, brain surgery. But the Patient Protection and Affordable Care Act got rid of all of those maximum lifetimes, so now insurance companies must cover everything. The Affordable Care Act also stated that preventative care must be offered for free, such as colonoscopies for, say, men over the age of 40 or people at a higher risk under the age of 40. Women also receive free colonoscopies. Mammograms are typically free. Blood work, annual checkups, well baby care are all now free under the Patient Protection and Affordable Care Act. It also states that every plan must now have a maximum out-of-pocket loss, also known as a stop loss. That means that a customer cannot pay more than roughly $7,000 a year in deductibles, coinsurance, and copays. Now, every plan has different deductibles, copays, and coinsurance, so some people's stop loss may be less than $7,000. For example, my stop loss is roughly $1,500. If I come out of pocket $1,500, I don't have to pay anything else other than my premium. Every doctor visit will be free. So the stop loss consists of coinsurance, deductibles, and copays. The Affordable Care Act is typically for small business owners, contractors, the unemployed, and anybody who does not have employer-sponsored health insurance. So like hairstylists, cashiers, well, they might have insurance. Restaurant employees, insurance agents, realtors, small law offices. Affordable Care Act is fairly good for any small business owner. Next thing we have is HIPAA, Health Insurance Portability and Accountability Act. This does deal with privacy of health-related information, but it should no longer be on the test because the Affordable Care Act made a lot of HIPAA's other aspects outdated. If you have any questions about how to get health insurance, you can either email us at support@texasinsurancetraining.com. We will not sell you a policy, but we can get you hooked up with somebody who can. Or you can go on healthcare.gov and create your own account and sign up for your own insurance. The time to sign up for insurance under the Affordable Care Act is roughly between November and March. It varies by the year and depending on how the government decides to run it that year. This is just a little overview of everything we learned. Adverse selection, high-risk people seeking insurance. The Commissioner and the Department of Insurance regulate insurance. Certificate of authority helps the insurance company transact business. Domestic, foreign, and alien are where the insurance company was incorporated at. And then the 4 elements to a contract, then the different types of contracts, then representations and misrepresentations, the Fair Credit Reporting Act, and COBRA. Pretty much everything in this chapter could be on your state exam. If it were me and I were you, I would use this chapter as an overview, and I would take the practice tests to really hammer these definitions into your head. They're not really conceptualized aspects that need a whole lot of thought. You really just have to learn the definitions and the dollars, numbers, and dates, and you'll be A-okay on your test. Whenever you're ready, feel free to go into the next chapter.